Oh, good morning. Sorry, I've been talking and I didn't realize my mic was muted. Oleg, I don't know if I could go.
Ah,
I don't know if I could go through that big monologue I just did for 2 minutes. So go on, take the mic, Oleg.
ah, Hi to everyone. I'm very happy to be here. I'm in a beautiful place. I shared it already, this place, photos of this place in my Twitter. So it's Black Sea Coast, Crescent region, not very far from my house. And I want to say that I was very impressed by the conversation with Jerry with Mike Melicinas, and I was very impressed by the words of Jerry that the way we trade is the way we think and the way we look at life. And for me personally, it's very important mindset because often I give people advices, and it's not about trading, not about maybe even business field, and I give people some advices using my trend following mindset. And people say, "Oh, how wonderful it is! How do you know such interesting things?" Um, for example, about small independent bets and so on and so forth, about diversification, about risk control, and so on and so forth. And it's because of my it's trendful and logic of a trend follower. So our great philosophy, it's an evidence that our philosophy is really great. And so I'm very happy, and I was waiting all week, as always. Was thinking a lot of trend following, and was waiting all the week our conversation. So let's get started.
Wow, good job. The next time I have to take a Friday off, I'll just put you in charge, Oleg. Well, what I was saying for 2 minutes was just talking about the some of the podcasts that Niels did and how I enjoyed them. The recent one, especially, was an interesting CTA, interesting approach from those guys, and then just talking about some of the trends, the sugar and the cocoa. They've been kind of fun being in the small markets and the softs. And those trends have been sort of choppy, but the loose pants has worked out pretty well for me to still be in them along with OJ. And I think it's interesting you trading both contracts of sugar, U.S. and London, and cocoa in the U.S. and London. I think that's worked out pretty well. It's a little bit different price patterns, and actually got knocked out of U.S. sugar, but have been in the U.S. or the U.K. sugar for quite a while. So there is some diversification on trading both, and with multiple trend following systems. One thing I tweeted this week that I thought was kind of funny was, yeah, I mean, this guy on the podcast with Niels, he was hard to understand because his hit a thick French accent, but he said some interesting things. The whole idea about was very interested, very defensive of Sharp ratio and was not going to back down from Sharp ratio. Like some of the other CTAs have backed down a bit from it and recognize that it's not a great measure for outlier trends that dominate the portfolio sometimes. But he said something pretty interesting that we've repeated. Or I've repeated, for years and years. That CTAs want to be uncorrelated and they want to be a hedge. And he says you can't be both. Either you're uncorrelated or you're going to be a hedge. And he said it's very inconsistent. So I thought that was pretty funny that I'd never picked up on that. And I think it's kind of true, right? I mean, yeah, thought that was interesting. What else? Oh, yeah, I've tweeted this article about this group, CTA in Sweden. Their quote is capital preservation is as important as capital appreciation. A lot of our product design and portfolio construction process is based on reducing drawdowns. And like, I don't really try to reduce my drawdowns so much. It's just make the most amount of money versus, versus the risk I'm taking on the losing trades. And, letting the profits run and accepting the drawdowns is really integral to protecting and growing your capital. If you don't maximize your opportunities on the upside, then you're building up all these small losses, and you have to make your fair share on the upside in order to put that money in your capital account so it can handle all those small losses. So I think it's kind of you can't ignore the fact that reducing positions and paying attention to vol and taking small losses and all these correlations and volatility and all this money management overlay is great. I mean, some of it's not great, but okay, you're going to do this to try to reduce those drawdowns. But basically, if you try too hard, you're going to reduce those profits. So I think that's something that always need to be remembered is that you need to hit the ball out of the park on a few trades every year just to pay for all those losses. Okay, anybody ready? Richard.
G'day, Gary. G'day, Oleg. G'day, everyone. Great to be here. Look, I haven't had a chance to fully digest that the latest podcast with Niels. The accent was a bit thick, and I was trying to sort of come to grips with it. But it's probably going to take another listen. But I did hear what he was saying about trend following not being a tail protection strategy, being an uncorrelated strategy, and I think that is important. We do know that trend following is uncorrelated, and I think that when we deal with trend following, of course, we're always saying it's trend following plus nothing, and being uncorrelated is great for us. But when there are people that are looking to sort of integrate trend following into a traditional portfolio, from a marketing perspective, it certainly helps them to make it sound as though trend following offers a hedge, when in reality it is still uncorrelated when it goes into that traditional portfolio. So there's no guarantee. But so it's not classic tail protection. It's uncorrelated, and because it's uncorrelated, one of the things is it gives benefits from not simply providing a degree of cushioning when markets, go into severe downturns, because obviously within severe downturns or extended trending periods, that's where trend followers make their money. That's on the downside. But importantly, being uncorrelated, they also offer this upside when particular asset classes are experiencing booms. So it's something for both booms and busts, not just busts, which tail protection strategies tend to focus on. So, whilst it might not be negatively correlated to equities, being uncorrelated certainly has its advantages in being able to service both the left and right tails of a market's distribution of returns.
That's right. And, some people have said accurately that trend following is really is sort of insurance. Can be sort of an insurance. I prefer it to be an insurance over the entire portfolio. Trend follow your stocks, bonds, currencies, FX, commodities, long and short. But some people do use it as a insurance. Somehow a small allocation to the 60/40 can give you this insurance, and it has been periods where it has paid off, but it actually pays you. It's insurance that pays you. There's no, it doesn't subtract from your bottom line. In fact, my point is your bottom line will be a lot better if you just trade the trend following and with all those wonderful markets. One thing that maybe we've talked about this, but I wanted to bring it up again, and that is there was an article, there's been articles and there's been papers written about how such a small percentage of stocks, 2 to 4%, make all the money, in a buy and hold. There was a Wall Street Journal article that I tweeted, and this guy who wrote the article called them super stocks. So if you miss these super stocks, you will miss the returns of the market. And so it's a little bit like outliers, in trend following, but you have these outliers in buy and hold, but it's only like 2 to 4%. And He says in there, searching for the next super stock is like hunting for a few needles in an immense field of haystacks. And I write, it's nothing, not the case if you use a trend following strategy, as almost all of the stocks will make money and contribute. And that's what happens with trend following. You can't leave that part out. Because some people will use that, well, most people probably use that fact of the 2 to 4% as the reason to own the S&P 500 or own an index. If you don't own the index, then you'll miss the 2 to 4%. And so, but it misses the whole point, which is you don't need to trade, you don't need to own the index. You can turn all of those stocks into almost every single one will make money. And then all of them have an equal chance of being this outlier and giving you immense performance from single trade. So the trend following takes all of those 50-60% of the stocks that don't make any money and turns most of those into profitable trades as well. That study has been out for many years. Blackstar did it many years ago, and it's been redone many times. And it's so I think that's kind of an interesting fact. That's what trend following is all about, is that almost all the money, almost all the markets contribute to the bottom line.
So, hi everyone. First of all, it's a wonderful Friday in London. It's April, so it's not that cold, so it's excellent. This week I was listening the short term traders interview with Neil Roy Niederhofer. So basically, he describes his strategy as finding repeating patterns occurred thousands of times where human behavior biases left signatures on decades of market data. And he goes into the details of pattern recognition, why it is important to use a machine learning algorithm to recognize these patterns, which is the way to systematize and automate. Pattern recognition strategies are usually through machine learning, either through fuzzy logic or some other machine learning style. So definitely these guys are pattern recognition guys on the short term. And Roy Niederhofer also describes his strategy as mainly contrarian. He mainly counter trend, but not always. Okay, so he basically said that he's a mainly contrarian trader. So, but what he really means is, when trading short term, of course, being a contrarian means that you're still able to capture those tails of your distribution, right? Like I do, so the contrarian against the main trend, but you're not contrarian against the trend that you're trading on your distribution. So these so when the deal has asked him whether he's a trend following trader, of course he's not. He's definitely not a trend follower as we understand it. But because he's a pattern recognition trader, there are times that he goes with the trend, and there are times where he goes against the trend. But his style is slightly different, and his time frame on the short term is from few minutes to let's say 2 to 3 days on some strategies, and 5 to 10 days on other strategies. So he has two buckets of strategies. Some of them are 0 to 3 days, and the second bucket is 5 to 10 days. So he was complaining about 2018, why his strategy didn't do well during Volmageddon. I think that's pretty known to Richard was also speaking about why it was difficult for the models for 2008 to capture. But so we've discussed whether last week whether he was a trend following trader. No, he's not. He's not a trend trader, but he goes with the trend like many other pattern recognition guys are. Richard, you asked the question last week, but this week I've listened. I hope this clarifies your question.
Yeah, thanks for that, Alp. Look, I have had a good listen to Roy Niederhofer, and the way I'm seeing it is that he's targeting trends that we don't target. In other words, the trends he's targeting on the short term are based on things that can be identified through pattern recognition. See, I tend to view those form of trends to be, trending components of larger mean reverting cycles, things that have a predictable nature about them. When you can apply artificial intelligence to it, you can apply pattern recognition to it. But I think the trends that we focus on in the tail regions of the distribution of returns, they tend to be trends that are manifested by collective human behaviour. So, in other words, things such as the impact of crowds. That's what gives these trends in the tail region these sort of enduring sort of signatures that last for a very long time, and that's why we don't have any profit targets. We let our profits run. They're extremely extended in nature. They're extremely material in nature. They dominate our P&Ls. 5 to 10% of them dominate our P&Ls. This is different to what Roy is focusing on, and I think that there's quite a few systematic traders out there who probably they'd call themselves trend traders, but I don't think it would fit into how I'd view trend trading. So, I view, there's certainly trends in other regions of the distribution of returns, such as in the mean reverting areas of the distribution, where a lot of people get their alpha from. I certainly don't get my alpha from that region at all, but I'm certain that momentum-based strategies, short-term momentum-based strategies do. So I tend to think that you do have to be fairly careful about what type of trend you're targeting in calling yourself a trend follower. There is definitely a distinguishing factor there. I think in the system application, the processes used to target those trends, and someone like Roy is definitely not in our camp.
Yes, yes, but there's a slight but there in terms of the I mean, it's a pattern recognition guy anyhow, but when he was talking about the months that he was making money, like June 2022 or March 2020, basically these are the months that also my systems are making money. It's just because the short-term nature of the price moves. In my trend following system, when I look into my actual results or backtested results, there are lots of similarities, and that's all right. Sometimes I might end up with a high correlation with other short-term traders, and that is okay. So that's not a big thing. So sometimes long-term traders have high correlations among themselves, and sometimes short-term traders, because when things move fast, whether you're recognizing that trend to a pattern, or you're just trading a 5-day breakout. Both of those systems, whether it's the double bottom that you're trying to capture with your machine learning algorithms, or you're trying to do 5 days breakout, both of those are going to capture the move in June 2022 or in March 2020, and you're gonna record for that. But I think when things are going bad, that's where we're gonna have a lot of difference with the pattern recognition. How you're dealing with the negative skew is going to be the major point of differentiator, rather than the positive skew, so to speak. So that's one point. The second one is, during this week I was lucky enough to be able to find a ticket to the Society of Technical Analysts in London. It was a phenomenal conversation to hear conventional point of view, but there are some interesting gems here and there. Okay. Perry Kaufman is always an interesting personality to listen to, and I've liked his podcasts I've listened to. So he mentioned something else. So it's not the way I trade, but some of you trade like that. So let me share his view. So it might be interesting for some of the people listening to us. So basically, he he mentioned that his shortest term trend following strategy is for 60 days. That's one point he mentioned. And for shorter term strategies like these 60-day strategies, it's a little bit choppy. So because it is choppy, he would prefer to use profit targets for that. Not longer term. He doesn't use profit targets for longer term strategies, but for shorter term. So that was an interesting point I thought to share it. Second of all, he also added a relative momentum component to his long-term trend following strategy, in a sense that he's exiting some positions after ordering them somehow. So is using relative momentum in conjunction with classic trend following seems to be some traders' choice. So that was interesting to observe. And also, he finally mentioned the signal to noise ratio. And he mentioned that from 1970s onwards, some markets have higher noise ratio, and in those markets, it might be better to use a mean reverting system where the noise is higher compared to the signal. But I mean, he basically has made an excellent 1 hour presentation, but those three, I thought that it's just a different angle than what we usually speak. So just wanted to share. Thanks a lot.
Actually, Jerry, you're in the headlines for the CMT Association. They're having a seminar, I believe, in the next few days. You're going to be there.
Yeah, I'll be interviewed next Thursday at 1 o'clock in at CMT, and it'll be a lot of softball questions about trend and how wonderful trend following is and how great it is. And then I'll, of course, have my talking points about adding single stocks and trend following those in a portfolio and classic trend, of course. So it'll be more of the same for me. Nothing. I'm sure I won't say anything that you haven't heard before, and I don't have any more turtle stories, and no, I just pretty much talk about the same things all the time. Um, I thought it was kind of interesting that Roy. I liked his podcast, and he's a bit different than us, but he always talks well about trend following CTAs, especially when he's doing better than they are. He doesn't pile on too much, but he said, "Oh yeah, it was kind of funny because Niels quoted him from a previous episode saying that you can't trend follow fixed income on the short side. It just doesn't work." And so that's kind of funny, this predicting and all of this anticipating of what's going to happen, what the fundamentals will be like, what's the ATR at the entry. That's going to matter quite a bit. But he didn't really back off too much on that. He just said it wasn't his fault that he got it wrong. But it's always good to remember that really smart people can't really predict the changes that might occur in the fundamentals that would make a trade pretty good. Then he sort of talked about bias in systematic trading, and there's bias in human behavioral biases in systematic trading. I totally agree with that. I think one of the biases that people have in systematic trading is above more important things is to try to attempt to make systematic trading smoother and with less drawdowns and less volatility, which I think that's a bias. If you can do it, great, go for it. Don't choose something. It's tough. It's tough to do. I can't do it. I'm not willing to do it. I want to make the most amount of money.
I had to laugh when Roy was saying that his initial thoughts about short trading fixed income, you know, he hadn't anticipated an inverted yield curve, and I was thinking to myself, well, you know, a short environment in fixed income, you know, to not include sort of an inverted yield curve in your assumptions there, I think, you know, it's pretty obvious that that was a major flaw in his thinking.
Exactly, and it kind of just reminded me just now of the great financial crisis when in the explosion in the mortgage market, and someone proudly proclaiming that, well, you can't blame all of us. We didn't realize that home prices could go down. So what? We don't blame you. And you know, next time, watch what we predict next time, because we won't get an inverted yield curve, or the fundamentals will be different. Then I will be correct.
It's interesting, Alp, about Perry Kaufman's thoughts, and you know, I tend to, I love Perry, always have, but I definitely think he's not an exclusive trend follower. I definitely think that the way he talks about trend, I'm interpreting that as he's mean reverting, and you know, when for instance his application of profit targets. You know, the application of profit targets in a trending environment works in a mean reverting environment because under the sort of nature of mean reversion, it's an oscillation about a level of equilibrium. And obviously you put your profit targets where that equilibrium is going to be to make maximum opportunity with that. So it's different to what we're doing in that our assumption is that out in these tail regions, trends are enduring. There is no equilibrium. There's multiple equilibriums. You know, it's a chaotic environment out in that region. No common standard deviation. And you know, the rules that Perry would be applying would be sort of almost forbidden in
I
my
can't hear you.
approach because that's not the way I'd view those tail regions occurring.
Yeah, I agree with you, Richard. I mean, that is, but you know, you can call yourself a trend follower these days and do anything. You know, it's some of these guys on the podcast with Niels, they were doing all kinds of stuff. And it's very common knowledge now that no one would rule themselves out of being a trend follower if they didn't, you know, not letting profits run fully the way that it used to be done, and the way that you and I do it is that just in their world does not disqualify from them from being a trend follower. For God's sakes, no, it's just the way we all do it. Neil said he brought that up. He said something. He was making an example of. He was trying to come up with an example with some discussion on the latest podcast. I forgot what it was, but he prefaced it by saying something about vol managing or oh yeah, it was this whole idea that there was an article out that blames hedge funds and maybe CTAs on following the trends in energy and soybeans and corn the past few years and being responsible for increased food prices. And Niels made the point. There was many good points made, but one of his points was actually in those trends, those uptrends in those commodities, wheat, corn, beans, etc., the volatility started going up, and so at some point in time during those trends, the CTAs were reducing positions. So they were the opposite of what they were being accused of. They were selling, even though I think he kind of said buying or selling from CTAs and hedge funds doesn't really have much to do with the price, especially when you have a lot of billions being spent by these large CTAs on ways to execute trades that don't move the market. So once they try to get in with no slippage, no movement, they pride themselves on spending money on research and doing this with these algorithms. Then once they're in, all they can do is put future pressure down on those markets. And so Niels was saying that, and he said, like, we all were selling due to high increased fall. And he goes, well, I mean, you know, all of my friends were selling or something like that. And because he was just sort of insinuating accurately that the whole CTA industry does that. And I was like thinking, oh, I want to be Neil's friend. I want to be one of those friends. I want to be in that group. Not really.
Hey, everybody. Happy Friday. I was wondering if anybody else saw the article, I think it was in Bloomberg earlier this week, about AHL talking about their AI model and AI in general, about how it's now able to predict or it's able to judge Fed statements as bullish or bearish, and then how it's able to predict stock price action after earnings based on kind of sentiment stuff. And I thought what was so interesting about it, the way they had trained the model, they had put all these Fed statements, the language of the Fed statement into the machine, and then a trader or an analyst would judge each statement as bullish or bearish, and that was what made up the model. And what I thought was so interesting about it was, people have been judging Fed statements since the Fed's been around, and then just as they're doing it, they're either wrong or right on the way the market actually moves. And it seems like a lot of people are kind of concerned that AI is going to take over the investment world, and all it is just models that have been trained by people that have the same, have a varying track record. Just because an AI model says markets are going to go one way doesn't mean they actually are. And price, as always, is the best indicator to go off of for trading.
Yeah, I think that's pretty interesting. I think something like that actually, might work. It's just, maybe a short-term thing, which way is, and analyzing this verbiage, they can see maybe what's going to happen over the short term, but stay away from situations where you can predict, you're going to get run over by an outlier or get run over by not taking a small loss. I think this is probably a bit different. I've been, I don't know what your opinion is of ChatGPT, but I have not been happy with ChatGPT, mainly because I keep running into these issues that I don't know how to get around. So enlighten me as it relates to the data only being through September 2021. So I've been using Bard because the Google version, and I think that because so many of my questions I need to be answered based upon more recent information, like what's the market cap? What does this company do? Which companies are involved in this particular industry? And so it's really a limiting factor to use ChatGPT. I have 4. I pay $20 a month, so I'm kind of like not using it as much as Bard. And both of them seem to be fairly inaccurate every now and then. And then I wanted to ask Seth about these breakouts in the Bitcoin and Ether, and then in some of the related stocks as well.
Yeah, I've been happy to see them. I'm long both the Ether and Bitcoin micro futures, and I looked back. This is the first time I've been long any crypto since May of last year. So, having been really successful in crypto in 20 and 21, I hope we can see another big run and maybe see some new all-time highs, and we can ride along with it. I'm not really familiar with any of the equities on the crypto side. I was pretty focused on the individual tokens. I've recently started trading stocks again in the last couple of weeks, but I haven't added any crypto specific stocks to my system, since I'm already in both the futures, and I trade a pretty limited market set. But hopefully it's an uptrend, and we can ride it to the moon, because they certainly have the ability to move big when they finally start moving.
Yeah, I pay attention to Riot and Marathon, maybe, and micro strategies. You think I would know more about my own stocks, but I just trade too many of them and I can't keep track of all of them. But yeah, so they kind of have been sympathetic with. But what's Marathon, Digital, Riot, and micro strategy. Yeah, so what's disappointing or limiting about the stocks is so many of them are. There's not just many to choose from. They've kind of gone away. It's kind of like I monitor and can't wait to get long marijuana stocks, but they're all in these monster downtrends for many years, and they're all worth about $1 or $2. So I'm concerned about that particular. There's not much left in those industries.
Joe, just on your question on ChatGPT, look, yeah, there is a limitation with its the data that's kept up until 2021. But for instance, I can go in there and I can say, give me a table of the monthly returns of the SGCTA index from January 2000 to September 21 or whatever the last date, and it will generate that table. And then what you've got to do is you need to supplement it with inserting data for the period 21 up to current day to then augment that table, which you can do. So if you provide data to ChatGPT, it has no problem in dealing with the data, and but it does have that limitation. But also, ChatGPT is integrated into Bing, the search engine Bing, which allows you to be on a website in Bing and use the ChatGPT functionality, which sort of overcomes that 2021 obstacle because it's referring to the websites directly via Bing. So, yeah, there are a few little workarounds there you can do. But look, in relation to AI, I do feel that AI is going to make significant inroads in pattern recognition, and particularly I think it's going to influence what I'm referring to as convergent traders. I think it is going to be a significant tool that can assist them in pattern recognition. But in relation to our world of the tails, I don't think it's going to. I think it's going to find the same obstacles that humans face in our region of the tails of chaos, where I certainly think that even if we get advanced AIs being able to interpret trends, they're not going to be able to also assess the impact of alternate AIs that are doing the same thing, which is what we find in our world of the tails, where it's more sort of impacts of trader behavior out in those tails, which is a collective behavior as opposed to an individual behavior. And when you get collective behaviors of AI, I think they're going to run into the same problems that we do. So I'm not really worried about AI sort of dominating our space. I think we're pretty safe, but I certainly think that convergent traders probably do need to adopt and accept AI as a means or a tool to sort of extract that edge out in their environment.
So trend following is a computational issue. So, for instance, I refer back to my algorithms as computational intelligence. Okay, because to be able to trade short term, you need to have some sort of sophistication to algorithms. So that's why I call them computational intelligence. But the artificial intelligence is, yeah, I totally agree with Richard. It's more about the pattern recognition. But still, we need some sort of intelligence, be it a CI instead of an AI. But going forward, so artificial intelligence is shaping everything else we do. Now, there is this, instead of ChatGPT, there is this AutoGPT is getting a lot of popularity. So, there are lots of things that we do in the trend following. So, for instance, I have automated the execution, so it is automation there, but still there are lots of things that I am doing. Would it be nice to just to outsource more and more to the AI. So AI is going to impact trend following for sure, but it's not around the trade execution or deciding, to trade 200 days or 205 days, but just we will be able to have the luxury of, outsourcing, for instance, which system parameters to choose. At the moment, it is still human based, right? So your parameter selection, your system selection, you're still, doing that piece of work with the brain. But with the I think it will be a major step if that research is just being done and then the decision process is being done by the AI. So you don't actually, as a trader, you're not going to decide on whether you're going to trade 200 days or 240 days or whatnot. Okay, AI is going to give that decision, and also there's still room to be able to outsource to the AI on some of the controls that you do. Right, if you're looking into your account to be able to understand what is happening at the end of the day or maybe a couple of days per day. So you might actually outsource that to the AI as well. So yeah, I mean AI is definitely going to impact the way we trade, but not the actual system execution or not the actual systems that we do. But we will have AI colleagues working with us. I believe very soon. Thanks.
That's a great point, Alp. I've actually been playing around with AutoGPT, and it is amazing. For instance, you give it a command such as, "I wish to create a trend-following portfolio. Can you please, determine the steps required to undertake a portfolio compilation process?" And then it goes through its auto-generative function, where it then identifies the tasks in procedural steps. It's amazingly powerful. What it's lacking at the moment is what they call the arms and legs. In other words, it's able to issue the commands in a synchronous manner that is optimal, but then to link to the particular software to undertake that task, it's sort of still finding its arms and legs to do that. But once it does that, I can see AI being a major assistance in taking someone from scratch and developing comprehensive, diversified portfolios. But as you say, the trade execution and the signal generation, etc., probably still need to be left in the hands of a trend follower. But all the rest of the tasks I can see AI doing.
Hello, Jay.
Hello, Michael.
Hi, everyone. Yeah, I think the AI will create a new generation of backholders, and this is what is going to happen. AI is nothing new. There have been many funds using advanced AI in the last 20 years. They haven't done very well. And a large language model cannot do better than the information it finds from various sources around, like on trend following. It finds information from articles, books, and everything else. As far as Fed statements, there is no clear correlation between Fed statements, macroeconomic variables, and the trends in the markets. All predictions have probabilities assigned to them, and the expectation is not known. So most of these articles are clickbait. They are written to get clicks and generate ad revenue. In the 80s, there was a big push started for neural networks. So it peaked around the 90s. They got nowhere. Then genetic programming took over. Then classification or supervised classification, they led nowhere because of the simple reason that markets adjust around participant behavior. And this is why trend following works in the long term, because these systems cannot alter the fundamental nature of the trends. They can only affect the short-term volatility. And as far as short-term trading, I heard the discussion before. It used to be great, fabulous in the 80s, early 90s. I was doing really well with it, and then the predatory algos took over, and you couldn't use any stops for those strategies that Richard calls convergent, and you had to eliminate the stops that increase the tail risk for these strategies. They are very risky. You can only allocate a very small percentage of the portfolio to convergent strategies, maybe less than 10%. The skew is negative. You cannot use any stops before they destroy the profitability due to the actions of the predatory algos that go after the stops. And there are many of those in the markets. Regular behavior, it's normal. It's normal for people to go after the stops of other people. That's what makes a market. Trend following works in the long term. The one entry, one exit, one stop. I have tested dynamic stops, trailing stops, everything you can imagine. All these things increase the complexity. They add no value. Maybe they add care fitting. And you just have to hope there will be enough trends. And as Jerry says, if you add stocks, you have more probability, higher probability that you will get some trends. And this is the story. All these things about AI, yes, it's a large language model. It's useful to get some information fast. I do it all the time, but it's not information you cannot find anywhere else. That's where the GPT finds the information from other authors, and there are problems with it. They will go after this GPT because of intellectual property violations pretty soon. Already in Europe, they are after GPT for these reasons, and I don't see any value. It reminds me of the sentiment hype, the social media sentiment algorithms. If you want to see how these have performed, look at the Buzz, BUZZ ETF, how it has done since inception. Is down 47% after falling as much as 65% in 2022. There is no AI sentiment. All these things are just buzzwords. The hard work is stay disciplined, find the trends, and work hard. GPT won't do that for you. Have a nice weekend, guys.
I had a program issue for maybe 30 minutes, didn't hear nothing, but I hope now it's gone better. So, I want to say that I have heard now what Mike said, and I agree that something like dynamic stops and etc. It's only adds complexity, and I also didn't find any value. And for me, I didn't find answer why I must be complex. Why I must be to be more complex than I am. And the best decision, I think, it's really one enter, one exit, stop loss, like Jerry teaches us. So it's the best way. Classical trend following way is the best way that I have seen.
Yeah, Michael brought up an interesting subject that I remember back from my early days, which is running stops. And so the turtles were being taught how to trade from these really smart people as it relates to math and science and computers. You know, there was sophisticated back testing and an understanding of mathematics behind trading and trends and much more. But they did have a lot of experience trading on the floor, and they definitely thought that people running your stops was something to be very concerned about. So the first turtle rules were what was that? 20 days in, 10 days out. System 2 was 40 days in, 20 days out. So you sell at the 10-day low to exit, and you buy at the 20-day high to get in, but not so fast. That really wasn't the exact rule. The rule was look at the chart, look at the 20-day high, but if the 20-day high, but around that area, there could be a symmetric looking top, a peak in the chart. So it could be 23 days, 25 days, 14 days. So put your order in before that peak. So because they're going to run the stops above a chart pattern or below a chart pattern that looks symmetrical. People will put their stops above that on a long, on a buy, and below that on a sell, because people want to they're drawn to those symmetrically looking patterns and peaks, and they want to make sure. Oh my God, you've got to make sure that it goes through. I mean, what could be worse than it not going through? I bought and it didn't go through, as if that's some magic. That's just a human bias, right? And so the turtles were told not exactly the 20-day high or the 10-day low, but find that peak. If there's a symmetrical place around there that it looks like stops might be building up, get in before, because it's going to be a domino effect. You're going to get filled, and by the time you get your fill back, they will already run that all the way past to get all of those resting orders on that place on the chart that looks very obvious. So we had a beautiful combination of real world trading in the pits, which is what was happening then, and their experience there, and then the math and computer back testing that they were very good at. And then there was a lot. The big thing that's been lost from that type of training and trading that we did was the contrary opinion. There was definitely pay attention to when the market might get overbought or oversold in a dramatic way, and maybe speed up your entry or exit if it seems like people are too bullish, or probably just your exit. Speed up your exit if the taxi driver is telling you he's long soybeans as well.
Also, I have to point out that most of the things we are talking here about trend following apply to CTAs and probably accounts larger than $10 million for in the case of USA traders because of the need for diversification. And for instance, Richard, I know uses the CFDs. You cannot use those in the United States. I have developed a system for trend following commodity ETFs. Those are weird because sometimes they do not track the underlying well, and they have volatility drag. But for retail, most of the things we are talking about, one entry, one exit, one stop for diversified trend following, does not really apply. I think we have to, Jerry, make this distinction here. What do you think?
Oh, I didn't understand part of that. What distinction are you talking about?
I'm talking about the fact that you need a minimum account for trend following, and I estimate this around more than 5 million to about 10 million to have sufficient diversification in futures markets and equities. So this idea of the ideologo trend following applies to mostly to CTAs and professional traders and not to retail.
Yeah, that's a good point. I was thinking about that today, and we don't really get into anything too much beyond entries and exits and one entry, one exit, and a stop loss. And there's so much more, irrespective of account size. Even if you have $1 billion under management, there's so much more to putting together a good systematic approach. We talk about them a bit, but it's like building a very complex house. You want to get there's so many things to take into consideration about, building a house on the west coast of Florida in a hurricane area. It's complex. And it's the same way with the trading system. There's a lot of moving pieces, a lot of moving parts. But I think that someone asked me this week about trading stocks only. And I'm like, yeah, I don't have a problem with trading stocks only with trend following. And you can have a very small account size if you just trade stocks. But you kind of are going to get some, you're going to have shorts on, let's say, and the shorts are very difficult. Someone else tweeted that, this thing about Andreas Clonau saying it's almost impossible to make money shorting stocks. So I'm like, yeah, that is very difficult. Stocks in general, shorts in general don't make a lot of money. Stocks in particular don't make a lot of money because when you size them with the ATR, you are essentially measuring, you're obviously measuring if the stock goes to zero, how much you're going to make. And for stocks in particular, there's not a lot of profit to the downside usually in shorting stocks because the ATRs are unusually high as a percentage of the price of the stock, unlike commodities, currencies, and interest rates. Commodities are in second place as being bad, but not as bad as stocks. Nothing is as bad as stocks. So the potential profit in a short can be very small in stocks. So you would be tempted to filter on that. And so I think, like all shorts, mainly their main purpose over time is to offer diversification for periods where they are making money when the sectors kind of move, but you're probably not going to get as many outliers on the shorts as the long. So it's not just stocks where the shorts are limiting, the profit potential is limiting, but it's all the markets, but we trade them anyways. It's, as I've said before, it's kind of like my sacrifice. I'm not going to trade mean reversion. I'm not going to trade crappy ideas that cost me over time, except the shorts. Okay, all right, I'll trade the shorts, but I'm not going to do mean reversion, pattern recognition, carry, negative skew stuff to smooth out my performance. So that's what I do the shorts for. It smooths out my performance somewhat. You've got the need to keep them in there for sample size reasons, etc. Then I told this whole idea to Rich one day after we had left and this turtle program was over. And I said the same thing to him at a lunch one day because I was wanted to get his feedback on trading a lot of equities. And he was positive on trading equities, of course, the single stocks, whatever. But his response was on the shorts was one of these days the shorts will have big trends. So that's the proper response because you're not supposed to slice and dice the sectors and the longs and shorts and look at those particular statistics, trade stats and equity stats, and say, aha, only trade the commodities or only trade longs or overemphasize currencies. You're not supposed to do that. It's the average trade in the for all the markets, long and short, and there is no such thing as being able to overweight or underweight certain markets or sectors based upon the back test. Not for trend following. So, back to the original question. I think if you said this many times, if you are a small account and you want to trend follow stocks and ETFs and the commodities and currencies and interest rates, I think that's a great way to get started. You can trade with a shockingly small amount of money and get in practice with getting diversification on all those four sectors and practice shorting. And then when you get more money under management, you can start wading into the futures markets, etc. So I think you can have a diversified portfolio, not just stocks, if you trade the ETFs.
In Canada, you have CFD. So, I mean, so this democratization of this diversification happens with the CFDs, of course. So either you're going to do it with CFDs or you're going to do it with options. And if you don't want to be doing options, and if the account size becomes an issue, then you're gonna come to Europe. You've got CFDs in Australia, New Zealand. You've got CFDs in Canada. You have CFDs, and you're gonna make hard choices and move on from one location to the other. So that's my response to it. And I'm not joking, really, because it's so unfair that the CFDs are just not provided in US. I find it just incredible, but if you're serious about your trend following, you're going to move to Canada. Thanks.
Jerry, those authors that they say short stocks does not generate any profits, they are right because they look at long-term back tests, but they are wrong because it's the short stocks that provide the convexity during the bear markets. And also those people don't understand or don't even know the Parondos paradox. If you have two losing strategies, you can end up with a winning strategy. And of course, you can show this mathematically, even in the markets, how to losing strategies in the long term, they can generate a winning strategy. But the important point here is the convexity during periods like the GFC, the pandemic crash, the dot-com bear market, and the skew, the positive skew, these short stocks strategies provided. Now, about the ATR thing over price, I have tested it and I don't agree, but that's my interpretation. So I think it's important to be able to trade short stocks, but it's tricky. There are many details there, and of course the broker makes a huge difference, the performance. Now, as far as options, the time value loss, we basically render these strategies not useful. You're basically going to be working for the market maker in the long term. That's my idea.
Oh, tell me what you don't agree with as it relates to the price divided by ATR. I didn't follow that.
Yeah, I have tested that, and I didn't see any problems shorting stocks. So once I have found out that it doesn't even matter, the ATR, because anyway, you can accumulate positions along the downtrend, and the idea that a stock has only 100% potential to go down and infinite potential up, it's not really a useful idea, because you can have many positions along the way and average the position and also what's important is you will during those crashes you don't need to follow long trends in down stocks. They will provide convexity for a limited period of time.
Okay, I think I understood what you're saying, except for the last part. But okay, yeah, I think. Okay, so we're both correct. I'm correct in the sense that I don't accumulate positions. Okay, so yes, if you're continuing to accumulate, I think that's what you said, this position on the way up and on the way down, and as the ATR gets smaller and smaller, you add to this position. I think this is like something that Absolute has said before too. Yes, so classic trend: one entry, one exit of a stop loss. We hit the breakout, we go short. That's the ATR. We put the position on. We don't change that position unless we go flat due to the stop loss, or we go flat due to the trailing stop. Move to Canada. I love that. I mean, I've never heard that idea before, but golly, that is so amazing to say that if you love trend following, if you're serious about it, you got to move to Canada. What a great, I mean, that's the quote of the day.
Or Australia, Jerry.
That's right. Well, I have to say, I'd go into my wife and say, I love you, but I really love trend following. We're moving to Canada. You get a choice, Canada or Australia. That would be an interesting conversation. Right. And so since we're going to have this static position from the breakout and until we get out, and we're not going to change that position, in a short, we're going to be locked into, we know what the maximum profit is. What happens? How much am I going to make if it goes to zero? Well, when I shorted it and there were 10 ATRs to zero. I'll make 10 ATRs. And that's not an outlier. It's not enough of an outlier for me, giving, it's not going to be 5% of my biggest trades. So that's the problem. Now, you can cheat a bit because if you trade indices, okay, I'm going off on a tangent here. If anybody wants to pick up on this and kind of ask me some insightful questions. I'm an expert on shorting stocks, trend following indices and stocks. I've spent a lot of my career thinking about this and working on this project. But what happens with the indexes is that it contains a lot of stocks, and the ATR gets influenced by the diversification in the index. And so the ATR is artificially low because it's a lot of stocks. Some are going up, some are going down. Let's say at some point in time, the stock index is a short based on your system. Doesn't mean every stock hit a low that day. Some of the stocks may have been in downtrends for a while. Some of the stocks in the index could be in uptrends, and some could be kind of just flattish. So you get an artificially low ATR, which would allow you to have more room to the downside if you're using ATR, which we all are, hopefully, or we should be. And so here's the bottom line. You could take an index of stocks, the S&P, and be short with a lot of room to the downside, 80, 90 ATRs to the downside, but none of those stocks that make up the S&P could have that sort of characteristic. The ATR for most of those, the possibility of if the stocks went to zero, you might make 40 ATRs. So it's kind of an illusion there, but it's a useful illusion, I guess, that it's probably better to short indexes versus shorting the components.
Actually, Michael, go ahead.
Oh, thanks. Okay, Jack, I agree with you. My point was that the short stocks would not provide the same average trade as the long, but you need them when there is the bad times, the crashes in equities, and they provide convexity to the whole program. So yes, you are right, but these stocks, although they have limited potential, they provide this diversification to the whole thing. This is one thing. The other thing is that when you trade the stocks short, you don't care so much how much you make on those stocks. Probably what you make on those stocks, it will be like the median of what you are making in the long stocks. I don't know. Did I make myself clear?
Very clear, and I agree. I would just say that I agree, and I do a lot of shorting in stocks. If it's a downtrend, and so because I do a lot of buying when there's an uptrend, so I like to have both, and that's more difficult in currencies. Let's say not now; currencies are kind of mixed now, but I was short all the currencies for a year or so recently, and still short almost every single interest rate on the planet, and have been for a year or so, or whatever since that trend began. So in stocks, you have a bit more, even though they can go to a high correlation for a day or two or a week or two or whatever. The chart patterns the stock, some of them you'll be short early on before that even happens. So stocks I like, but for that reason. But I would also say that you can't give up on the potential profit in the shorts. We don't want, as trend followers, to make these big claims because we hadn't seen grain profits in 20 years or thereabouts, and all of a sudden we saw grain profits. So we haven't seen stock profits in the back test consistently, but we may see them short profits in the back test, but we may see them one of these days. We just can't make that claim. We're not supposed to look at the markets that way. And one more thing I wanted to say is that there is a tension here and some sort of necessary break-even analysis that I do that I think needs to be done by classic trend followers, because we're not primarily, or I'm not primarily, paying a great deal of attention to the equity stats, the historical performance and drawdown and smoothness. I'm trying not to pay too much attention to that and focus totally on the trade stats, the average trade, the average win, the average loss, the win percentage. It's blackjack. I'm making bets, and I want to have this healthy probability of making money on the trades so I can get really focused in on the shorts are not that great, try to limit the shorts, try to come up with a system that is A plus, that takes great trades. The average trade is really large. You're going to get that from really loose pants systems. But you need to sort of also not forget that the equity stats matter. As Michael said, you kind of don't want to get rid of those shorts because they will help you with that convexity and to protect you when you're getting your ass kicked with the longs and the long stocks especially. So you need to kind of pay attention to both, but I still try to do that. And I do that as well as anyone because I have such loose pants and they let in a lot of shorts. I don't try to limit them too much.
Yeah, I mean, in the short stocks case, I mean, what's going to happen if we end up with another, 1929? a Great Depression case. I mean, we all have heard about Jesse Livermore. He has made a lot of bucks by shorting the stocks, right? So I know, and of course, there's in the world there's always the risk of ending up the third version of this world war as well. So that might become an opportunity to short the stock. So you wouldn't want to be missing that if you can survive that war, of course. No one wants that. But on these black swan events, in the data that I'm looking, my data is just for 20 years. I'm a short-term guy, 5 minutes data, 1 hour data. I'm just looking for 20 years. But if you want to really go back, multiple decades to 1929, 1945, at the beginning of 1900s, and looking to, what was happening, I'm sure, shorting stocks was a legit idea. It's just not that thing didn't happen recently, and maybe it's not going to happen in our lifetime. Maybe I'm just going to die before seeing any opportunity in the short stocks, but we never know, right? So that's why it's an insurance for our systems, and that's why we short it. No, thanks.
I agree that we don't know the future, and we don't know what the future environment will bring us, what the future will bring us in terms of environment. So I agree with all this, that, of course, and Niels said that many times, that we trade shorts because we don't know what the future will bring to us. And probably that shorts will be in a good shape in the future. We just don't know.
Oh, another thing, Jerry, I got distracted from many screens here. I want to say that, yes, we say one entry, one exit, one stop, but I have 12 systems with different entries. And each one has one entry, one exit, and one stop, but they take different entries. So, yes, this is one way you can accumulate positions along the trends, and especially the short side. Now, I just back tested that small caps, one entry, one exit system, that ominous system, and the average trade for the longs is 1.25%, and for the short is 0.28%, 0.3%, let's say. So it's like a quarter of what the shorts provide, a quarter of the average trade. But without the short, you are losing all the convexity.
Yes, true. You'll pick up some convexity in the CTA portfolio from the other currencies, commodities, and interest rates, possibly. But yeah, I agree totally.
Yeah, hi guys. Yeah, I was busy with some other stuff last couple of weeks, so I couldn't join. But I did listen to the recordings, interesting discussions. Regarding the size of the portfolio for a trend following strategy, I think it also depends on the strategy, and it depends on the approach. There are some approaches that are more amenable to smaller size portfolios and smaller number of markets versus the others. And this is, for me, also one dimension which I think is very neglected in our industry. It's one dimension by which one can compare one strategy versus another. They're similar strategy. Let's say they're both trend following strategies, but so let's go beyond Sharpe ratios or drawdown ratios or whatever. But if one strategy shows more consistent performance and better performance on smaller number of markets and with smaller capital, that's a superior strategy to a strategy that demands sufficient diversification and enough capital to achieve it, to achieve a certain level of performance. So, for example, let's say two strategies have similar performance on 300 markets, and they're different strategies. So different, whatever, one entry, one stop, so whatever. There's like a range of trend following approaches. But if so, the strategy one and strategy two. If strategy one can provide a narrower distribution of PNLs, of equity curves, so a narrower band of equity curves with 20 markets. So let's say out of those 300 markets, we pick subsets of 20 markets and we trade strategy one with it, and we do that 1,000 times, whatever. Tuples out of the 300, and let the strategy one do that. And then strategy two trade 1,000 tuples out of the same 300 markets. The width of the equity curve bands, the higher quality strategy will hopefully have the similar tilt of the 300 markets, hopefully, overall, but the band of the 1,000 equity curves will be narrower versus the band of the 1,000 equity curves of the strategy 2. If that is the case, that's a quantitative way to prove that strategy 1 is superior to strategy 2. So when this is another way of, so this is, I haven't read this in textbooks or whatever, but when you're trying to decide robustness, when you're trying to pick parameters, when you're trying to decide which strategy is better, which one is more robust than the other, this is one overlooked way to actually comparing apples to apples versus two strategies. So for me, for my strategy can perform okay with 20 markets. I can have 5 from each sector randomly picked, and 20 markets, it's going to have a pretty decent performance. I mean, it's going to be superior to almost even with 20 markets. And also, I've been running some very small accounts for friends and family who don't have a lot of money. So the smallest one I've had just for fun is it's $500,000. So with $500,000, 20 market strategy with $500,000 performs pretty nice. No CFDs, futures, five markets from each sector for 20 markets, and they're doing pretty well. So this is just another color I wanted to add to discussion of about whether you can trade this with small accounts or whether you need 10 million to do it. And then to go to another extreme, which also I guess depends on the strategy. So let's go to the extreme. You can compare one approach of trend following versus another on just S&P and treasuries. So let's say 50-50 S&P, 50 treasuries, so stocks, bonds, or 60-40 or whatever. So the benchmark is 60-40 portfolio, which all the pension funds are exposed to. If you can have a strategy that trades the one leg and the other leg with some kind of a trend following strategy or whatever that outperforms it, anybody can do that. And anybody can do that in their IRAs, in their whatever, and they will be outperforming 95% of the both long only and alternative and hedge fund and CTA industry by just small application of trend following principles to S&P and treasuries. So it's very easy to overthink. I mean, we are on a different level. We discuss different nuances and what's better and what's not. But the power of momentum, and not just trend following, the power of momentum is so robust and so overpowering that with a very simple momentum or a trend following overlay, many things can be improved. And a lot of people with even smaller amounts of money can improve their savings or their accumulation or their compounding of their wealth. So that's what I just wanted to add.
Very good. I have a lot to say about all of that, but you want to go? Do you want to go, Richard? Do you have anything you want to say? I took copious notes here, so I'm ready to.
I agree with absolute there in its entirety.
Oh, well, it's. I mean, I don't know if I disagree or agree. I just need to comment. Yes. So, well, first of all, I think that it's pretty correct. However, I need to comment. So, I agree that trend following, because of the outliers, infrequent outliers, it needs lots of markets. And as you said, others don't, probably to the degree that they don't rely upon the outliers as much. I think you worded it better than that, but I agree with that. Oh, the higher quality strategy. You had to throw that in. Okay. All right. You have a higher quality strategy. I don't care about that. Now, I would say, though, that, and this is just the same discussion we've had many, many times. So you're just really good at coming up with other good ways of describing it. But I would just say that the problem here's the issue, and we've talked about this a million times, and that is that your higher quality strategy, I think I wrote that down correctly, is based upon the back test, the robustness. I don't really know what you mean by that. I know what my definition is. I think that it's different. And but I think you're talking about the back test and the performance. You've obviously had good performance, but let's just say we don't know what your future performance is going to be, and we're not even talking about your systems, but just in general, all of those managed futures CTAs have a higher quality strategy than mine. So, and they probably define robustness differently. But it's not just a question for me as to what does that back test look like? Oh, there's less outliers. I don't need to trade 300 markets. I can trade a lot fewer markets because the distribution is more compact. I think you said that, something like that as well. Okay, because we get back to the same old thing, which is it's probably going to have more parameters. And it's not one entry, one exit, a stop loss. It is more stuff, more correlation management, more volatility management, more whatever management. And so there's more parameters. And so my definition of robustness is the sample size, fewer parameters, fewer variables. And so I'm willing to say, essentially, that yes, in the back test, you kick my ass, but you kick my ass mostly in the risk part, and you're smoother than I am. And I will on purpose choose an inferior, a less higher quality strategy in order to knock down the number of parameters and the variables, even though and I've said this many times, I'm totally willing to be, that I'm totally accepting that I could be proved wrong. And my response is, I don't care. So that's the first part. And I think about this momentum versus how powerful momentum is as well. And but I was thinking the other day, it's really momentum versus systematic trading. So I think people who have other ideas, and you're right in saying momentum is powerful and can help all kinds of ideas, fundamental value, growth, whatever, throw some momentum on it. I've joked that AI could be great if the last part of AI is I'll buy if it's in an uptrend. I think the Fed speak indicates we should buy bonds, but I'm waiting for the breakout. Yeah. So I think momentum can help a lot of things, but it's not systematic trading, which is an entry, an exit, and following these overbearing rules and not just some sort of overlay of momentum.
Yeah. So no, I agree with you, Jerry. Listen, and I'm keep listening to these spaces. There's I have fertile soil, fertile ground for these concepts that you and Richard and everybody in these spaces is talking about, and that's why I keep coming back. Eventually, something's gonna seed, and some seed's gonna grow into some kind of a tree. So I can probably see that. So the argument was, we were talking about smaller accounts. So if, and this is how I also connected it as a measure, not comparing. This is also another way of showing robustness, because going beyond the point, and I will repeat, I'm not going to go into details, but I have less parameters than you. But going beyond that, one way to prove robustness is that as you throw your model unseen data or combinations of it. So for example, let's say you test a certain system on 20 markets, five markets from each sector, let's say, from each asset class. And then I'm going to try to decide whether I want to be a classic trend follower or something else, something different. Also momentum-based trend following, but something different. The choice whether you pick one or the other will be very dependent on which 20 markets you choose, because depending on whether there are outliers in your backtesting periods or not in the 20 markets that you choose, you may end up choosing classic trend following versus not. Then you go pick another 20 markets. That's why I said you pick 1,000 twentuples or 100 or whatever. So my point is, if you have a strategy that no matter which twentuple you throw at it, it kind of gives you the similar slope, similar, of course, more or less, depending on which markets you choose. But my point was that with classical trend following, the range of outcomes of the equity curves, you're going to have a flat equity curve, you're going to have like a slightly rising, then you're going to have like a one that peaks and then kind of slightly goes down. So when you put all those equity curves on one chart, the tree of equity curves, starting from zero, going upwards, hopefully, the tree in the classical trend following of those twentuples will be much wider than a strategy that's more robust. And I measure robustness in the narrowness of the tree of equity curves. So let's, and if you have actually chosen a strategy with 20 parameters, right? Let's say you build a strategy and you have 20 parameters, correlation, whatever, and you've curve fit your strategy for these 20 markets and you produce an equity curve. The lack of robustness will show when you throw that same strategy to the other 100 or 1,000 twentuples. Because if you have curve fit on those 20, you will definitely show no performance on the other 100 or the other 1,000 of twentuples or 20 market portfolios. And that equity curve tree, the tree of equity curves, will be much wider. So I'm proposing here a quantitative measure of robustness. It's the narrowness of the equity curve tree. So you have something robust. Robust means blind to specifics on one market versus another, or blind to the past versus the future. So robust means focusing on something that's general, universal, and eternal. That's robustness. And that robustness will be shown and it can be quantified by the width of the tree of the equity curves of the 1,000 twentuples that you throw your strategy in. This strategy, no matter what you throw at it, it ends up making money and with a narrow sequence of equity curves. They're not the same. One have peaks, bottoms, and whatever, but they're narrower. So the narrowness shows the robustness. I just wanted to make this point. I haven't read this anywhere. I haven't read it in a book. This is my concept. So I don't know what you guys think about it.
Yeah, just something quick. With this definition of robustness that you provided, trading stocks short will never ever be robust, because if the only reason why we trade is stocks short is to be able to capture a second Great Depression moment, to be able to make a lot of money out of it, like Jesse Livermore in the history books. I don't think that will actually satisfy this definition of robustness that you provided, or maybe it won't satisfy any definition of robustness where we can say that robustness is universal or sample size. So, the more we talk about robustness, I started to think less about the validity of shorting stocks. It's just not, it doesn't look robust to me. Thanks.
Yes, yes. I also was going to comment on the shorting. Yeah, thanks for reminding me. Al. So this is connected. I think whether whether to short stocks or not, I don't think it's connected with robustness. I mean, I refer to robustness as something different, but I will make 2 points on shorting stocks. And these are two powerful forces which classical trend followers need to take into consideration when they discuss shorting. One is the limitation of the strategy itself, and I discussed this with Jerry. So the strategy as designed with one entry and then letting you enter at $10 short, and you know you only have $10 to make, or you do calculate the ATRs. If the ATR is $1, you have 10 ATRs to zero, and you're basically limited, which goes against the philosophy of hunting outliers. So that one limitation can be, of course, solved and overridden if you keep adjusting ATR, as I proposed to Jerry. But that's, again, so if somebody is philosophically against that, then I understand it. But one limitation. Another limitation for shorting anything in this post-1971 world is this is a 50-year experiment where the world has been detached from gold for the first time, completely. Up to 71, before Nixon closed the gold window, there was some tether between currencies and physical gold, which Nixon decided to completely sever. In 71 says, you know what, you bring dollars, we don't give you gold, and so be it. We have the biggest military. What can you do to us? So all our rules of thumb, careers, books, even the turtles, even the trend followers and whatever. So everything that we know, careers, fortunes being made, everything has been made in this post-1971 fiat system, which is completely detached to gold. And when the monetary system on a whole planet has been detached to gold, the propensity of governments or the printers in the basement on this planet is always to print more than less. Because whoever is in power, you have demands from pensioners, from people, from poor people. You need to buy voters. You need to pay your cronies. You need to start wars so you can pay your cronies. They can build bombs for you, make your friends rich. So the incentive of a human, even not psychopathic one, and I don't even speak about psychopathic humans, the propensity of human will be to print more untethered fiat than less. And because of this, prices of everything will have a huge tailwind from behind to push them upwards. So when you're shorting anything in this post-1971 world, you're actually fighting a very strong tailwind of human nature, which hasn't been tethered to physical reality, which is gold. So that's what makes shorting even more difficult. And this is what makes average trades on shorts smaller than the average trades on longs. This is that tailwind, which is still lasting and undeniable there. So these were my two points to make of why shorting is so complicated. But I think
Let me
go on.
let me make some comments. Okay, well, I want to comment on the other stuff, but shorting is difficult due to the gold. Okay, I didn't get that. Okay, but anyways, let me go back to the specific trading stuff. So now I'm guessing here, but you'll set me straight. You said you have fewer parameters than one entry, one exit, and a stop loss. And I think that you want to say that because you're not going to count all of the other trades you do, where you just mentioned the adding to positions if the volatility goes down on the shorts. So you don't want to count those money management trades. you don't have to count those. Well, I count them. They're trades. And they get back to the whole sample size idea and the number of variables and stuff. And I would say that you threw in something about it goes against hunting outliers. Look, the sample size and the integrity of the system supersedes everything. So the sample size, the system, the number of trades we have in the back test, this, is the first. You can't even trade, much less hunt outliers if you don't have that squared away. I would never, if I could only trade 20 markets, or if I decided to trade 20 markets, we may disagree on this one, but theoretically, I would not optimize the 20 markets. I would optimize the 300 markets. I would say to myself, the truth of what works in trend following is best determined by testing a lot of markets, even though I have no desire or I am unable to trade as many markets as 300 or whatever. I only want to trade 20. I can only trade 20. I would never optimize on the 20. I would just get the data for as many markets as possible and come to the truth of what works best, what trend following strategies and parameters works best on the 300, and then use those on the 20. That's how I would do it. I lost my track. I'm really not sure what to say about this narrowness of the equity curve, but I don't think that trend outlier trades that produce big profits and would maybe cause the equity curve to not be as narrow in any way should that be interpreted as a negative as it relates to robustness?
Now, Jerry, I think
I agree with that, Jerry.
Okay, can I just respond quickly to this, Richard? This is very important for us to understand each other, Jerry. I didn't mean to say that one equity curve is wider than the other equity curve. What I was saying that, let's say, okay, so you say you will test on 300 markets and only trade 20 markets. Let's say you have money just to trade 20. Which 20 markets are you going to trade? How are you going to choose? And if you trade 1,000 portfolios of 20 markets each out of the 300 markets portfolio, so you have, let's say, 1,000 possible choices, the likelihood that you pick one that has produced a flat equity curve is non-zero, because the range of possible equity curves, you have 1,000 equity curves. One of them could be a flat one over 20 years, did nothing because it got no outliers in those 20 markets. I'm just exaggerating. Or it got one outlier and then it kind of sits down there. If you pick the best 20 markets, you're going to have a lot of outliers and that equity curve is going to go very high. The best 20 markets. So between the worst 20 market equity curve and the best 20 market equity curve out of those 1,020 market equity curves, there's a wide range of equity curves that cover all possibilities. And you will still be left with the decision which 20 markets to choose. Are you going to choose the 20 best markets out of the 300? That's going to be selection bias. You're going to choose the 20 best markets out of the 20-year period that you looked at. You don't know which 20 markets are going to be the best, average, or worse in the next 20 years. So if the possible outcomes of equity curves on 20 markets is very wide, you're still going to be left with blindness and with deciding which 20 to choose and based on what. Whereas if the 1,000 equity curves on each 20 market portfolios are narrower, you're less dependent on which 20 markets you choose. You may choose the worst one or the best one or anything in between. The difference in performance of the 20 years, there's going to be a difference, but it's not going to be as big as with a strategy that's dependent on whether the outliers are in the 20 markets or not. So my argument is not about a Sharpe ratio, about drawdown ratio, about how one equity curve looks like. My argument here is that with a more robust strategy will be less dependent on your choice of 20 markets, even when you choose your strategy and you build your strategy on 300.
It's not, yeah, but I agree with all of that. So you're kind of skirting around my issues, but you're getting excited about things that I agree with. Okay, that's fine, but I don't agree that that this lack of narrowness is an indication from a trend following perspective that it's not robust, or that something that has more parameters, more moving parts, more vol and correlation management, a heavy dose of money management. I don't think that is more robust. So, but I do agree that if you do have a system with those characteristics, and it's robust and it's able to do it with having a large sample size that I would approve of, which I won't, but if theoretically, if it's possible, then I agree with what you're saying. If I could take my systematic approach, one entry, one exit, and a stop loss, and really no overlay of money management, and somehow, and that's sort of what the shorter term trend following used to do. It would have this more narrowness than we have now. But then the shorter term stuff kind of went away, and thus kind of the need for adding more things to it. But all I'm saying is that when you do the 300 back test, this is giving you an indication of a better indication of what's going to work in the future. We're all subject to choosing the wrong markets. CTAs don't choose the wrong markets because they trade them all. And they trade anything that's a future that's liquid. I think there is anxiety, and the reason that people don't want to trade single stocks is because there are 20 known futures indices, or 30. Let's trade them all. Now we can get this anxiety behind us. If we have to choose individual equities, what if we choose the wrong ones? Of course you're going to choose the wrong ones. Some of them are going to have outliers at different points in times, and there's no way to predict this. So if you're only trading the 20 markets, I agree with what you said earlier. Take 5 markets out of the 4 sectors, 5 of each from each sector, and maybe look at the correlations and say, okay, I'm not trying to predict the future. Backtesting these 20 markets has nothing to do with what's going to happen in the future. Backtesting 300 is way better for those 20, and so trade those. Try to maximize diversification, and that's all I do. I'm adding markets all the time, never running the back test, just trying to get more diversified in the portfolio.
Yeah,
I think the discussion here is about the need to adapt your processes dependent on your level of capital. So I agree with absolute that when you're dealing with finite capital, you don't have the ability to diversify widely. Then the tree of equity curves produced, you ideally do want a narrow band of your equity curves as a method of indicating robustness. But as you apply more and more markets and more systems into your portfolio with diversification, and you start looking at the influence of outliers or beneficial volatility in that tree of equity curves, you start seeing that some of those outliers are so large that the tree of equity curve splays out significantly. It's more the lower band of those equity curves that's important. Those markets or systems that haven't displayed outliers, which give you that narrow band, I think that is robustness. But I don't think we should be penalising beneficial volatility in any way, shape or form, which does have the ability to splay that tree out considerably to the upside. When you get that, it's not something that you don't want to. If you get that in your back test, you don't want to be excluding the impact of those outliers to look at an outlier-free sort of tree of equity curves. Anything to the upside is beneficial, so you just accept them and you allow that positive uplift to be a beneficial symptom of your process. But when you're dealing with small levels of finite capital, ideally you are looking for a level of robustness because you might be missing most of those outliers. So in the absence of outliers, you want to preserve your capital, and at the thin band of equity curves is obviously the optimal solution for at least identifying some form of robustness in your model without those outliers present.
Yeah, I will paraphrase a famous statistician here. Any measure of robustness loses its robustness when it becomes part of the process.
Mike, can you explain that more?
Yeah, sure. Some statisticians said once that if you have a metric and you use it to backtest, data mine, or something, and it becomes part of the process to judge the bias of the system, then after a while, this becomes part of the bias of the system. I mean, it's...
I get you. I get you. Yeah, that's interesting.
You should, because you know about statistics. You should get it, and maybe you remember who said this once. It's a very powerful statement. Absolute made a reference to a robustness. It's good, but it ignores the correlations. Most markets are correlated, so we are looking at the capital markets. There are 4 capital markets: the equities, the forex, the commodities, and the fixed income. And then you select from those. And we hope those are not much correlated. It happens during periods of time. They are all correlated. So those are the hard times. And any measure of robustness, because I have spent so much time on robustness and I have developed a robustness index it's always conditioned on past data. And in the future, you may not have the same robustness that you studied in the past. So robustness it's a nice theoretical idea. I agree with Absolute. He made a good description of a theoretical robustness. Maybe this is good for a master's thesis or even maybe a PhD. But in trading, you don't know the future, so you don't know the robustness. That's my point. When it becomes part of the analysis, the robustness stops being robust.
Yeah, well, I don't know. I don't remember. I swear I can't remember if that word was even used, but I'm pretty sure it was back in the day. I mean, to me, it just revolves around the number of trades you have. And of course, you have to put the trades in buckets. Entry, stop loss, entry, trailing stop. Those are 2 different buckets. We combine the longs and the shorts and the different sectors together to increase that sample size. So I think to some degree, I've been thinking about this. This sounds crazy, but I think to some degree, my system with 10,000 trades that doesn't make money is robust. It's not going to make money, but it has a lot of sample size. It has a lot of trades. I've counted them correctly. And I think Richard and I kind of have come at this from different angles, in that the way that I was taught is it is not necessary or proper to segregate based upon the size of the profit. So yes, there is what generates all the trend following profits is a very few number of trades, 5 to 10% of all the trades. That doesn't sound very sample sizey. Well, that's not correct, because it's the trades. You can count all the trades were generated by that entry exit combo. And some of them happen to be very large, very outliers, and they don't look like any of the other trades. Too bad. It's the way they were generated by the rules. That's how you count the sample size. So, and then with all of this correlation management and volatility management, I don't really know how to do that. Hey, you know what? It works in the back test. That's just not the same thing. It works in the back test. Okay, cool. And then some of the new the managed futures CTAs, they don't even have really discrete entries and exits. They're just like it's a soup of positions that are always being kind of adjusted up and down and up. And maybe, I guess, some sort of trend or relative trend is thrown in there. But it's far different from classic, which insinuates, we're counting these entries and exits together. That's one. The next one, that's two. And that's what we're talking about robustness. And if you don't have that sample size, I don't know what you do. I can't navigate around that.
I mean, I know that we just come to the end almost, but just a quick question to Jerry Parker. I mean, in terms of shorting the stocks, the sample size of winning days when we look into the 100 years or what? I mean, we're not going to have a robust result. Would you agree with that, Jerry? So shorting stocks is not going to provide robust profit results in whatever length that we would want it to look, but we are just trading it for the future, just the possibility of that we cannot predict the future.
Okay, I guess I'm being kind of weird and strict on that word, but so robust is just, to me, is it going to be reliable? And that's totally determined by the number of trades. So once again, I have the most robust system on the planet. It doesn't make money. So it's two entirely different things. Is it reliable? Is it something I can think might work in the future? Do I have enough sample? Do I have enough trials? And you need extra trials, according to mathematicians that I've listened to. If the data is filled with outliers, so that it's whether it makes money or not has nothing to do with robustness.
Can I just quickly confirm, Jerry? Yes, to explain this to Alp. Alp, robustness has nothing to do with whether it's making a lot of money or not. Robustness, in the simplest way, is determined as whether the performance that you see in a backtest, how closely related will be to the performance going forward on that same portfolio, or to the performance on another similar portfolio of unseen data. So basically, how close is the backtest result will be to real results as you start trading. That's robustness.
Yeah. Richard would like this. When we're talking about power law distributions, like in trend following, the idea of sample size doesn't make any sense. To have a significant mean return with a power law distribution, you need billions of data. Billions of data. So this is not what we're talking about robustness here. It's probably a significance of the mean and also the variance of the returns. But let's talk about the significance of the mean. We don't have the samples to measure this significance of the mean when there are power law distributions. In this case, we would need millions, billions of data to be able to justify this. So the whole discussion, it's really on very loose, shaky mathematical grounds.
Yeah, I do like that, Mike. I'm viewing robustness not in terms of profit at all. In relation to trend following strategies, I'm reviewing our upside as a statement of luck. Catching these outliers, responding to these outliers is purely luck. Robustness to me is your ability to defend your capital. In other words, it's all about adversity and how you keep your losses small and linear in nature. And when you look at your loss distribution in your trade statistics, there is significant sample size in that to actually make inferences regarding the losses, but the outliers are so infrequent and, in nature that there is no sort of statistical inference you can take from it. But by leaving your systems open, you can exploit that upside possibility, but it is luck. We try and minimise that luck by maximum diversification across systems, timeframes, and markets. But all of our opportunity arises from simple luck. We're risk managers, and all of our losses can be contained, and that's where we focus with our constraints of our systems to keep those losses very small in nature or linear in nature in relation to upside opportunity. That is something I think that we can get statistical inference from.
Yeah, but just to mention, the to be able to catch the outliers cannot be luck. Richard, come on. It's a property. It is a property. If something else is a property, it's not a luck.
Yeah, no, it is a property of markets. I've got no question about that. We do see it over long-term data sets. We see these outliers. But your ability through using your systems, the ability to capture outliers is a product not only of the market's behaviour, but of your system's behaviour. And if you don't have your systems aligned with the market, you won't get any outlier. So, the system deployment, how we actually capture those outliers, how we diversify our systems, how we deploy our systems, that is something that we spend a lot of effort in to ensure this maximum diversification. But it's all about, I do believe it's all about luck in the end game of our outcome.
I mean, when you say luck, it means simple, and simple may mean cheap. But, it's not, there's way more sophistication than luck. I mean, you could be just lucky by getting a lottery ticket.
I agree, Al. Luck is a process. So we turn luck into a process by diversifying widely. So we've got maximum opportunity to be in the right place at the right time. But being in the right place at the right time means that we need our systems on all the time, or active, or able to take trades, which means we've got to preserve capital at all times to be able to be in a position to take the opportunity when it strikes. We've got to be opportunistic. And also being in the right place means that we've got to diversify incredibly widely, but we'll never know where those outliers occur. But our process actually reduces a luck statement into a process effectively. So we recognise that there is a universal characteristic of markets that display these outlier properties. What is the most optimal process to apply to capture those opportunities? We apply that process, but really your outcome, we never know where the next outlier is going to be. So it is a pure statement of luck whether we're able to capture that opportunity, because it's the market that decides our fate, not the cleverness of our systems.
Right. So any one trade or group of trades is luck, but the process has the markets have that characteristic of outlier trades. Okay, it's been great. I'm going to go on to, I got to record my new podcast with Mike. And so.
What's the topic this week, Jeremy?
The topic, I think we're going to, we can't stay on one topic. And so I think I want him to start out and tell me more details about what he learned from Sakota and Drews and these other guys. I'm always talking about the Turtles and Richard Dennis and Bill Eckhart, but I think this Ed Sakota tribe stuff is, I don't know that much about it. I think they're sworn to secrecy or something. So I'm looking forward to seeing how much I can get him to talk about. Okay, it's been fun. It's always great for when Mike and Absolute show up. So thank you guys for being back. The conversations get really good. I really enjoy them. So thanks for being a part of all this, and thanks to everybody.